I think the big 30,000-foot picture of what you think next year will look like is actually disinflationary. And we should talk about that, especially on a day where yields are doing what they're doing. So maybe you can talk us through why.
I mean, I think the biggest story in the Trump agenda trade is deregulation. And deregulation is not talked about enough. Everybody's focused on tariffs, immigration, more stagflationary parts of the proposal, which I think are much smaller and much less significant than the deregulation. And I think that was true in 17, 18, and 19 as well, when he pursued a huge deregulatory agenda.
But do the effects of deregulation take time to show up? I think a lot of people might say to you, sure, in the long run, and maybe they mean 10 years, and he's only got 4, right? But do you think they could literally show up within a couple of months' time?
I do, because I think businesses are going to start planning for the next 4 years. They're going to know that they can do deals. They're going to know that things are going to move again. And so all of that planning comes in, all of that investment comes in, all of that decision-making to get together. And I think cut costs and merge and engage in activities that are ultimately going to be benefiting from the fact that there's less red tape involved in getting business done.
I love this, because what you're saying is actually even more of a twist than I think people might think when they think deregulation. They think of the really hard stuff, you know, the kind of stuff that Musk and Ramaswamy are going to be chipping away at dollar by dollar at a time. And it might, again, take a while. What you're really talking about is just a looser M&A environment,
absolutely,
which can happen on day one. And you think more M&A is basically disinflationary for the economy.
And it just brings business optimism. It's the NFIB survey. It just brings people to the table to get the animal spirits flowing. And I think that is optimistic for all business. It's optimistic for the cost of production and the expected cost of production for businesses to be lower. And that allows for room for prices not to go up as much and margins to be higher.
Can we do some myth busting?
Sure.
I think a lot of people think that M&A, they always say, like, you know, what are the lines I hear? They say, you know, all deals often fail to bear any, you know, real returns. You know, it's anti-competitive. It's bad for the consumer. It does result in a lot of layoffs and restructuring in the near term. So what about all of those kinds of dismissals of, you know, the impact of M&A?
Well, it can be constrictive for the labor markets. It certainly has been in the past, deregulation, and certainly innovation, and what we're talking about with DOGE as well. So all of those, I think, are variables we need to put into 2025 and 2026. I just think the question of speed is important, what you brought up in the beginning. And that, to me, is much more of an optimism, a mindset, a psyche that's going to come in. And I think businesses are going to be even confident that they don't need to raise prices. They can keep prices here or even lower them if they expect their cost structures to be going down in the future. And that's the way they can gain real estate with market share. And that's going to be an important thing, as deregulation really lowers the barrier to entry for all newcomers, for smaller businesses, for those guys that want to chip away at the bigger ensconced businesses. So I'm excited about that. I also, as you pointed out in the opening, you know, have a very, I think, controversial view on the structure of rates and where neutral is.
And the Fed, and maybe you can get into that. I mean, what do you, and as you've pointed out, they've actually done a lot of shrinking of the balance sheet. We were over $9 trillion, and we've come all the way down to
the high sixes now, six and change.
It's only almost $7 trillion in size. Where is it going, and what's the impact of all of this?
Well, I think from, you know, not to get too wonky and to go back too much, you know, we spent a lot of time over the last 2 years telling our clients that the balance sheet was still exerting stimulative pressure on the economy, and that's why the high rates weren't having the same impact. So we were actually in the higher for longer camp. We were sat on the show with you and many others saying this is not going to be the rate cuts that people think are coming, but what's priced into the market. There's just too much stimulus from the balance sheet side. The balance sheet is now kind of off the table in terms of the stimulus. It's back to what I would consider a neutral level, probably by the middle of the year, so about 20% of GDP.